Hey, Ike here. Welcome back to Live Richly, where we help each other become better investors. So what do you get when you combine Amazon, eBay, PayPal, Google, and whilst you're at it, throw in some FedEx? You get Alibaba. So in this video, we're going to be breaking down Alibaba, why the share price is down over 30%, and why mega investors like Manga, Prabai, and Ike are buying, and maybe you should consider adding this to your watch list to research further. So the usual disclaimer, this video is not financial advice. It's meant for educational and entertainment purposes only. I do own this stock, so just keep that in mind and take everything I say with a grain of salt. So now let's get into what Alibaba does. When most people think of Alibaba, they think of this, AliExpress, a place where you can buy cheap stuff in bulk. But Alibaba is actually the 9th biggest publicly listed company in the world according to market cap. And market cap is essentially the share price multiplied by the number of shares outstanding. So this is even after the 30% fall in their company share price. In this video, we're going to be focusing on the two most important divisions, e-commerce and cloud computing. This is because they make up over 90% of Alibaba's revenue. The main pillar of the Alibaba business is its e-commerce division, which represents 88% of the group's revenue. There are two businesses that you should be aware of here. That's Tmall and Taobao, which have about 811 million active annual customers. To get an idea of the scale of Alibaba, the active users on these two sites are 32 times bigger than the entire population of Australia. These businesses link buyers and sellers or businesses to businesses. The e-commerce business is growing at about 20% a year and has an operating margin of about 60%. This is a very important number because operating margin is the measure of profit a company makes on a dollar of sales, accounting for direct costs. So for the non-accountants out there, Alibaba is making 60 cents profit for every dollar of sales. And the reason Alibaba can do this is most people compare Alibaba to like an Amazon, the Amazon of Asia. And Amazon at its core is a logistics business, right? It's very capital intensive. I would argue that Alibaba is more like Google. Alibaba doesn't make its money from sales or listing fees, but instead from advertising fees from the merchants on their platform. This is actually something that Amazon is starting to implement, as it seems how successful it's been for Alibaba's business model. So a lot of commerce is moving online, and this has been accelerated by COVID. But in China in particular, Alibaba has the biggest market share of all e-commerce business, and this is projected to grow. The company was able to generate over $100 billion in revenue, mainly due to the e-commerce business during the past 14 months. During the COVID lockdown, the horror that was 2020, they managed to earn $100 billion. So the e-commerce business represents the present, the next pillar represents the future, and this is the one that I'm most excited about. This is cloud computing, which currently only represents 7% of Alibaba's revenue. So if you don't know what cloud computing is, it is the on-demand availability of computer system resources, especially data storage and computing power. So we access the cloud every day when we watch Netflix, like this YouTube video right now, when we're backing up files at work or photos on Google Photos, when you check your Instagram, when you upload pictures on Instagram. This is just one way we use the cloud on a day-to-day basis. And the global demand for cloud computing is skyrocketing. In 2019, the entire market of cloud computing was valued at $321 billion. But it's now expected to reach 1 trillion with a T US dollars in a mere 4 years by 2026. Now you know why I'm the most interested in this part of Alibaba's business. Alibaba is actually the largest provider of cloud computing in China, but they're the 4th largest in the world behind Amazon, Microsoft, and Google. They have a close to 50% share in China, and the cloud computing business grew their revenues by 50%, and this is projected to reach about 9 billion this year. And as businesses in China move from having actual physical servers, which are a lot more expensive than the cloud computing solutions available, This demand is expected to increase in China, and Alibaba, having a 50% market share, is seen to be keenly positioned to benefit from this growth. So at this point, you're probably asking yourself, why is the share price down 30%? Cloud computing is set to boom. They have a 50% market share in China, fourth biggest player in the world. That's a plus. The e-commerce business is the biggest e-commerce business in the world, essentially dominating in. Why is the share price down 30%? There are two reasons. The first one being $2.8 billion. That's the fine that Alibaba paid after the recent antitrust investigation in China. So they were accused of forcing vendors to only work with Alibaba and not their competitors, which is a bit douchey in my opinion. So the fine represents less than 20% of their cash flow over the past 12 months. And in the grand scheme of things, looking at the scale of Alibaba, this wasn't really an issue. I think their share price actually went up the day the fine was announced because they can afford to pay 2.8 billion. So if you take a second though and just pause and zoom out, look at the global view, companies all over the world are being investigated for antitrust behavior. In Europe, they actually introduced the GDPR as a framework on how tech companies should operate. Google was fined 220 million euros just a week ago, or I think a month ago, over their advertising practices in France. So my point is this: antitrust investigations are part of the course now. Governments around the world are trying to figure out how they regulate these mega companies that operate in different jurisdictions. So this is a risk that I think is inherent in all tech businesses going forward. It's something that's not unique to Alibaba at all. The second reason the stock is down is the cancelled IPO of Ant Group. And an IPO is an initial public offering when a company is sold to the public. So most people in the West aren't familiar with what Ant Group does. Think of a PayPal, but you can also borrow money from it. You can also invest money on the platform. You can also save your money on the platform, and it's really good for micro loans, especially micro loans for smaller businesses. So to get an idea of how big Ant Group is, last year it handled 17 trillion with a T dollars in payments. The company was valued at 300 billion pre-IPO before the government cancelled it. And the reason the IPO was cancelled is Jack Ma, the founder of Alibaba, made some comments that the government didn't agree with. And so he went missing for a couple of days, but now he's back, but he's still in China and can't leave. So do with that what you will. So instead of the usual why I like the stock segment, today we're going to be doing why I bought the stock. So I bought Alibaba because of the theme of the growth of the middle class in China. This segment is expected to grow to 550 million people next year, which is nearly double the entire US population. So more and more retail is going to be moving online, and Alibaba is primed to benefit from a wealthier middle class that can afford to spend more money on luxuries. The second reason is community group buying, which is something that's not really popular in the West, but this is the fastest growing segment in China retail. So how this works is you team up with your family, friends to secure usually fresh produce directly from the producers and eliminating the middlemen. And group community buying leads to significant discounts for the consumer and a guaranteed market for the suppliers. And this type of community buying is really big in tier 3 and tier 4 cities in China. So Alibaba has so far been focused on tier 1 and tier 2 cities. This is your Beijing and Shenzhen, but the move to tier 3 and tier 4 cities to capture this market is going to be seen as a significant opportunity for them. But they're going to be competing with the likes of Pinduoduo, which has been one of the fastest growing companies in China. They've been dominating this space, but Alibaba is a seasoned operator in all things retail. I think the market is big enough to handle two big players. The third reason I bought the stock, the third reason I'm bullish, as you can see here, is the cloud business, right? This cloud computing business grew revenue by 50% year on year, which is projected to keep increasing as more and more IT infrastructure is switched to the cloud. Alibaba is the #1 cloud computing provider in Asia, and the revenue from this segment is going to be a key driver for them, the same way it is for Amazon with AWS. So what are the risks of investing in Alibaba? There are two main risks that I am mindful of and that I keep monitoring. The first one being the ownership structure of Alibaba. That's the variable interest entity structure. So there are protected industries in China that foreigners aren't allowed to be invested in. So when you buy Alibaba stock from the New York Stock Exchange, for example, you are not actually buying shares in Alibaba. You're buying exposure to a company that owns shares in Alibaba. So all the big tech companies in China operate this way so that they can get access to that liquidity that's offshore. So this is how business is actually done. But just one thing to be mindful of, that in the structure, because you don't actually own the shares, the investor protections are limited for foreign nationals. So that's something to be mindful of when you're investing in these Chinese tech companies. Or if you want to understand a bit more about this, look up variable interest entities. I'll link some articles that go into a deeper dive into this if you're interested in learning more. So the second risk when investing in Alibaba is the risk of regulatory changes due to the antitrust investigations that are still ongoing. So I feel like antitrust investigations are just part of the course now. If you're going to be investing in tech companies, that's something you should work out if it's a risk you're willing to take. You have companies such as BlackRock that thinks that these crackdown on these China tech companies is going to last a while, and they're avoiding the space altogether. I'll link an article in the description. Feel free to have a read if you want to know more about how these big players are thinking. And let me know what you think in the comment section. Tech companies in China are depressed right now compared to their global peers. So if you're looking to make an investment, maybe this is a space you should look into. If you would like to learn more about the other investments that I've discussed on this channel, you can click here for my video on investing in water, blue gold. I think this is going to go to the moon. Or here on my LVMH video, investing in luxury, let rich people get you rich. And until next week, bye.